We had a conference in London on June 21st of last year for our European and Middle Eastern clients. And I kicked it off with the discussion of the environment and then took questions. And then after lunch, I got back up and I said, and unscheduled, and I said, you know what, I'm disappointed in the conversation of this morning. Because the only questions I got were, what will inflation be? How high will the Fed raise rates to reduce inflation? Will it produce a recession? When? How bad and how long? So inflation, rates, recession. These are not the things that matter. First of all, we can't know much about these things. Secondly, if we were going to do anything about, if we formed views, we probably wouldn't do much about it. Because I've seen a lot of people discuss, I've been on a lot of investment committees, as you described, Cyrus, and they spend a lot of time discussing the macro forecast, but they don't make big changes in response to their conclusions, probably because they don't really believe what they just agreed on. But, these are not the things that matter. And what I said was, what we try to do is we try to invest in companies that will become more valuable over time, and debt instruments where the issuer will pay the interest and principal as scheduled. These are the things that matter.
Fundamentals.
Fundamentals. And, I describe in there around 2016, or late 15, 16, when the Fed started talking about raising rates. I believe that they kept rates way too low, way too long. And then they got into this bind where if they started talking about raising them, they had a revolution on their hands. But anyway, I went through a long period of time, and the only question I got was, when will the Fed start raising rates? And I think I say in the memo, what does it matter? If I say March, what will you do? If I say, no, not March, May, what will you do different? And it goes back to the illusion of knowledge. And by the way, one of the quotes in that memo, somebody said, if people understood how uncertain the world is, they wouldn't be able to get out of bed in the morning. And so they cloaked themselves in forecasts to make the environment tolerable. And so, in early 2016, when will the Fed start raising rates seemed like an obvious question that one would like to have an answer to. But it doesn't deal with the question of, is it possible to obtain an answer to that question? And what would you do if you had the answer? Warren Buffett once said to me, as he said many times, that for a piece of information to be desirable, it has to satisfy two criteria. It has to be important, and the macro is extremely important. In fact, in the last 20, 25 years, it feels to me like it's the only thing people care about anymore. But it also has to be knowable. And I believe that the macro is not knowable in the sense that to be superior investors, all of us have to have an advantage, what I call a knowledge advantage. We have to know something better than somebody else, or clearly our investment performance will be average. But I don't think it's possible to know more than others about the macro. And consequently, I don't think that trading, which is in response to expectations regarding short-term events, I don't think it can be successful. And so I start the memo by saying, by talking about 5 things that I think don't matter. Short-term events, short-term trading, short-term performance, hyperactivity, and volatility. And, volatility, first of all, most people have subscribed to the view that volatility is risk. I don't think so. I think that the important risk is The two most important risks are, number one, the risk of permanent impairment of capital, or the risk of not taking enough risk and underperforming. But, you know, we care so much about volatility, and of course, a lot of performance is evaluated based on the Sharpe ratio, which is essentially the relationship between return and volatility. But why? And Buffett says, I'd rather have a lumpy 15 than a smooth 12. And I say in the memo, if you'd rather have a smooth 12 than a lumpy 15, you got to think about why. Is it for financial reasons, or is it for psychological reasons, emotional reasons? But I think that these are the things that shouldn't matter, but I think that these are the things that investment committees in particular spend the vast majority of their time discussing.
And Howard, why do you think, you know, it seems to me there's enormous focus on the short term.
Yeah.
Especially for, I'm going to say, public stock investors,
Yeah.
Anybody buying a security. Why is that? Look, most of what we do at Brookfield is private equity of some sort or another, and we own things for a long time.
Yeah.
So I don't understand the short-term thinking. What's driving that?
A great question spanning those two memos is what you just asked. Why so much time on what doesn't matter? And why? You know, look, why do you spend your time trying to develop a macro framework? And maybe if more people spent their time thinking about whether a macro framework can be helpful, they would change their behavior. But I think, and I talk about this in the memo about knowledge, but I think that I think most people think you have to. Most people think it's their job. Most people think it would be unprofessional or irresponsible to not hypothesize about the rate of growth in the economy and the level of inflation and the outlook for rates and currencies and commodity prices and that kind of thing. And they consider these things important, but they don't grapple with the question of whether they're knowable. And so, you know, at Oaktree, what I say is we ignore the micro, which is unknowable, and we focus on the macro. We focus on the micro, which is the knowable: companies, industries, and securities. And if, you know, this is a value conference, which is predicated on, I think, studying the micro. And if you read most value books or speak to Buffett and people like that, there's not a word about the macro. If you work really hard studying companies and industries and securities, I think you can get an edge that you can't get in trying to forecast economies and things like inflation and rates.